Afternoon, everyone. It's just an incredible amount of excitement for sampling today. Incredible amounts of excitement to see the enthusiasm in everybody's faces. So before we get started, real quick note about today. On the week 7 items in Brightspace, there's a document called attribute sampling tables that you might want to have access to. It's going to help us work through one of the problems. It'll also be helpful for your homework. But I used to print out a copy of that and give it to all the students. But in this day and age of environmental consideration, I thought, given the amount of time that we spent actually using this table, there's no need to waste a sheet of paper on it. We've got electronics that can do that for us. So I guess you might say that if I really wanted to go the full distance, I just wouldn't put it on electronically either. That way, I wouldn't have to waste the energy to access electronically. We just have to memorize the attribute sampling tables. That's just the way to approach it. I'm not quite there yet. It's also in the book if you need to access it that way too, but this is should be sufficient for what we need. So talking about sampling today, what is it that we're going to talk about? So a little bit of background on sampling. I am not a big fan of this chapter. It's not that I don't think sampling isn't relevant. I do think there's some very relevant there's relevant considerations for sampling techniques, but the book tends to heavily focus on statistical sampling methods. All right, and most accounting firms nowadays, they use non-statistical sampling techniques, which admittedly have a basis in statistical sampling, but don't actually use the statistical methods we're going to talk about. It's also important to note that new data analytics methods increasingly are starting to render sampling obsolete. And the idea being is that if we can test the entire population of items, there's no point in sampling. We get all of our assurance. Now, why am I going to be teaching this today? And the answer is very simple and straightforward. First of all, it's chapters in the book, so I do want to make sure I cover that. But more importantly, this is something that's covered on the CPA exam, which I realize that not everybody in this class is going to be taking, but it is something that I expect a lot of people in the class to be covering. And so I want to make sure that we at least have some coverage at it. We are going to cover this at a very basic level. I do not consider myself an expert at statistics. I knew just enough econometrics to get a PhD, and that's it, okay? And if you ask me what some of the stuff means in my dissertation, I'd be like, I don't know who wrote that, you know. But the statistics themselves are going to be very basic and very straightforward. What we're going to learn a little bit about is we're going to talk a little bit about some of the things that you'll want to know for the idea assignment. If you want to complete that, this idea assignment coming up is actually worth 10 points. It is a long idea assignment though, with a lot of steps. It's not difficult, I don't think. It's just kind of time consuming. It does take a little while to go through. So I want to give you a little bit of guidance as to what we're going to be doing with that. But we're going to spend some time talking about the concepts in the book. And then I'm going to give you a little bit of overview of what you'll be doing in idea and some considerations for that. So let's go ahead and get started. I will tell you that this discussion we're going to have today is going to focus very heavily on Chapter 8, a little bit on Chapter 9. We're not going to be doing directly any statistical sampling on Chapter 9 because it is a lot more challenging and complex. We can use IDEA to do the testing for us, which is very helpful. There's actually an assignment for Chapter 10 for earthware clothiers that I used to do in the past that was statistical sampling in nature. I kind of got rid of that simply because it was a little bit confusing given the lack of depth we spend on it. But if you do have some knowledge in this area, it still can be useful. You can still glean some application out of that. But for the most part, I do not expect you to be experts. There's going to be one multiple choice question on statistical sampling on the exam. That's about as far as I'm willing to go on that. So why do auditors use sampling? Well, it comes down to this idea of reasonable assurance versus absolute assurance. Which one of these do we use? Reasonable assurance, okay? So the idea being is that we can't test everything, and that's particularly true for really, really large organizations. If you remember, I talked about this a little bit on Monday. I said, what if I tried to test everything at Amazon, every single transaction? I mean, I would have to have infinite copies of myself, and even then, that might be a challenge to do. Infinite. Can you imagine infinite Michael Barnes? Dr. Caden would lose her mind. Yeah. So yeah, that would be something that nobody wants. But anyway, so we are going to kind of limit our scope, our focus on everything that we're going to be testing, and because of that, we end up with some issues. We end up with some of the possibilities of errors. And one of those things that we're going to be talking about is this idea of sampling risk, which is also considered to be the risk of incorrect acceptance from our perspective. Now, if you know anything about sampling, you'll realize that I'm also leaving out the risk of incorrect rejection. We're not as concerned about risk of incorrect rejection as auditors. So type 1 and type 2 error from a scientific perspective, it's probably where you learned it in your statistics and science classes. Type 1 error is saying that there's a problem when in fact there's not a problem. I'm not going to say we don't care about that as auditors, but it's less of a concern for us. We are very concerned about accepting something that's a problem. The risk of incorrect acceptance. That's our focus on sampling risk. So when we talk about sampling risk, the idea is that we draw a sample that is not representative of the population. So let's just go ahead and say, for example, I'm going to test all of my auditing students that I've ever had, which I average probably what, 40 a year, and I've been teaching for 10 years, so 400 students, and I want to try to determine what is the average performance on certain exams. I don't want to necessarily look at all 400 students, but I could test some small portion of that. And depending on what I do, I may actually pull a sample that's not representative of the whole population. Now, you notice there's a picture of a soccer ball there. That's not just happenstance. That's not just because I enjoy the sport of soccer. If I really enjoyed soccer, I'd call it football because it's the original football, guys. All right. But actually, if you think about it, why do we call it American football? There's we're running on our feet, okay, and there's a ball in the hands, and I don't know. Yeah, we value the kicker so much. You got to protect the kicker. Yeah. The actual story behind this is I was trying to use the representative sample of a population of a particular class, and the class that I was doing this for was an auditing class of about 30 students, and um, exactly 1/5 of the class were soccer players on the Truman State team, so men's and women's team soccer players. And I said, if I asked the question, all auditing students are soccer players, I could pull a representative sample of that class and have every single one of those people in the sample be a soccer player. So, and that was just going beyond, doesn't even include like club soccer or just kind of informal soccer players. So it's very possible that I could draw something that's not representative of the population. So it really depends on what is the characteristics of the sample versus the characteristics of the population. And that is a challenge because if we are not careful with our sample selection, we can reach an incorrect conclusion based on our derivation of the sample. Like I might say, I'm going to pick 5 people and I just happen to pick those 5 soccer players and said, this is amazing. All auditors play soccer. It's actually, I used to play soccer too, a long time ago. You're not going to see me out running out there now because I'm well past my prime, but I played soccer for like 14 years. So yeah. And so, yeah, could we actually make that conclusion? Yes. And so that's not necessarily a great conclusion because the simple truth is not all auditors play soccer. I have that as empirical evidence, but uh, basically, we want to make sure that we try to mitigate this risk to as much as possible degree. And the simple truth is we cannot completely eliminate it, but through correct approaches, we can try to minimize the risk. So let's go ahead and talk quickly about our standard sampling assumptions. Now, our goal in sampling is to draw a sample that is representative of the population. But in order to do that, we need to understand some things about the sample and the population that we're looking at. First of all is this idea of normal distribution. And if you remember from your statistics classes, normal distribution is that inverse U-shaped curve. It looks like this, all right, where most of our population falls within one standard deviation. Approximately 68% of our sample falls within that standard deviation, and about 95% within 2 standard deviations. Samples are unbiased and random, so we're not favoring any particular characteristic or trait in our sample selection. The samples are important, represent the population, as we've talked about before, really critical concept that we have to make sure we know. Also, the variance in the sample is also representative of the population. Now, this is an interesting one because if we assume that the samples are representative of the population, we also have to assume that the deviations that occur between the individual observations in a sample also need to be representative of the population. This occurs very frequently in business. If I'm selecting companies for testing, if I'm doing some test work for research purposes, I have to actually look at the average size of the company and then look at the large companies and the small companies. For publicly traded companies, there's massive deltas there. And so I can eliminate those in the population by just saying, I'm not going to select any companies over a certain threshold or under a certain threshold. But I have to do that for the sample as well. I have to make sure that the sample selection is going to be correctly representative of the population. And I think you probably remember the idea that when we talk about variance, that's characterized by something called standard deviation. Standard deviation is just basically saying that how far can I go in a certain direction and still be close enough to the median, be close enough to what I believe I should say median, I should say average, because median's not the correct term. what's close to my mean or my average. So this spot in the center where most of everything aggregates for the most part, this is our average. This is what we assume is going to be most represented. And we can kind of see a gentle sloping downward as we move one standard deviation and two standard deviations out. Again, the terminology for sampling, we're not going to be doing too much detailed sampling, so you don't need to be that clear on sampling detail or sampling terminology, but this is just kind of a rough primer or a reminder of what you should already know. All right, so let's go ahead and talk about our first category of sampling. We're going to talk about two categories of sampling. We're going to be talking about attribute sampling, which is going to be our big focus. And then we're also going to be talking about variable sampling, which we'll refer to, but not do a lot of work on. Now, attribute sampling is primarily used when we do test of controls. And the reason why is pretty straightforward, okay? It's testing for a specific characteristic. So what did we talk about when we say testing controls? You all did testing controls last week. Remember that? All right. And when you tested the control, what were you trying to answer the question? Or what question were you trying to answer? You're trying to answer the question, did this control work or not? Yes or no? And the characteristic is just a binary question. Did the characteristic exist or does the characteristic not exist? Was the signature for authorization there? Yes. Was it there? Not there? No. So binary test, it's very, very simple and straightforward. And accordingly, our sampling for the attribute sampling is going to be a lot more simple and straightforward than variable sampling. So variable sampling is extrapolating dollar value differences in a sample to the population. This can be many different methods we can use. We can use monetary unit sampling, classical variable sampling. There's dollar value sampling. There's a lot of different approaches that we could use depending on this situation. Again, I'm not an expert in this area. I can only give you a general understanding of what this means. So say, for example, that I'm testing accounts receivable and my client has literally thousands of customers. I can't test every single one of those customer balances. So oftentimes what I'm going to do is I'm going to use confirmations to send out and say, can you confirm what your balance is? So remember the confirmations are those third-party requests before? We're going to talk about those back when we get to the revenue process in chapter 10. But I would use samples, not full populations of confirmations to get some information. So what happens if a customer replies back and say the client does not have the correct balance, they're off by $500? Does that mean the population is off by $500? No, it means the population is likely off by some greater amount, some magnitude of order to that. How do we actually determine what that magnitude of order is? That's what variable sampling tells us. It says if we're off by $500 in the sample, then this interprets to some magnitude of being off in the population. Now, what is the magnitude? It really depends on the size of the sample relative to the population, but we use the statistical methods to actually determine what we believe that difference is. It is definitely not precise, but it does give us a level of precision that's sufficient for our procedures. So let's go ahead and talk about some common concepts, and then we're going to talk about some very specific concepts that are relevant to each of these types of sampling. So first thing we're going to talk about is confidence level. So confidence level is our confidence that the sample we've tested is representative of the population. Larger confidence levels require larger samples. So we're generally going to be operating on two different orders of magnitude when we talk about it in this course. We're going to operate on a confidence level of 90% and a confidence level of 95%. And we have tables that represent that. In fact, those tables that I told you to pull up, you will notice that this is a 95% desired confidence level. And then if we go down to the next set of tables on the next page, we have, next table page, we have 90% confidence level. Now, as the slide suggests, if we have higher confidence, we require larger samples. Let's think about this just for intuitively speaking, why this makes sense. If I want to be 95% certain that my sample is going to be representative of my population, do I want more observations in the same or population? Do I want more observations in my sample or do I want fewer? Well, more, because I want to make sure I have more to the greater number, the more closely I get to that final population number. If I need to be less confident, then I can use fewer sample observations. So that's the intuition behind that. Now, a quick note here. I call confidence level the inverse of sampling risk, which is a misnomer. You're going to hear me say that. You're going to hear me say confidence level is the inverse of sampling risk. Strictly speaking, that's not true, okay? Because inverse basically implies that you flip the denominator and numerator, which that's not what happened. What I'm talking about here is assuming I have 100% A confidence level of 95% would imply a 5% sampling risk. It's basically confidence level minus 100% minus confidence level is our sampling risk. On the other hand, if we talk about there's going to be you can transpose that pretty easily. If I say that my sampling risk is 5%, my confidence level is going to be 95%. If I say my sampling risk is 10%, my confidence level is 90%. In extreme cases, we could use a 99% confidence level, which would mean we want a really low sampling risk of 1%. So those are inversely related, but they always add up to be 100% is basically what we're trying to determine there. All right. Next concepts relate to tolerable deviation rate and expected population deviation rate. These areas are the ones that students traditionally struggle with conceptually for this particular discussion. And it's not necessarily difficult, but it can be a little bit hard to organize the thoughts here in this area. So tolerable deviation rate is just the deviation rate in the sample the auditor is willing to accept. So the number of deviations that we can accept and still think that a control is effective, something like that, all right? Tolerable deviation rate is expressed as a percentage. Then we have the expected population deviation rate, which is called the historical defect rate. And this is the deviation rate the auditor expects to see in the population. Now, why is this so confusing? The reason why is because these two have to be combined to give us some information about the sample size. We have to consider these two jointly. And it's important to note that we can't have an expected population deviation rate that's equal to or greater than our tolerable defect rate, or tolerable deviation rate. Think about why that's the case. Let's say that I can only tolerate 5% deviation in the sample, but I expect 8% deviation. Does everybody see the critical problem with that? If I expect more deviations than what I can tolerate, then I'm basically stuck not being able to do sampling at all because I'm going to see more defects than I can expect, than I can tolerate. So in order for sampling to work, our tolerable deviation rate always has to be greater than our expected population deviation rate. If that's not true, then we can't use sampling. We'll see why that's the case when we look at this in IDEA, by the way. Now, the way that I describe this is that the distance, and I put that in quotes, between the tolerable deviation rate and expected deviation rate is inversely related to sample size. So let's say that I have a 5% tolerable deviation rate and I have a 2% historical defect rate. If I increase my tolerable deviation rate, that distance becomes greater. That means my sample size becomes smaller, all right? Same is true if I decrease my expected population deviation rate, my distance becomes smaller. So if you think about these, like think about them on a bar, you say one is like 5, one is at 2. If you make that distance greater by moving either of those two numbers, that decreases our sample size. On the other hand, if I have them on a bar and I say one's 5%, one's 2%, and I make them closer together, my sample size becomes larger. So these two jointly should be considered a driver behind what our sample size is. Now, I do want to explain that the book, when you see questions on this in the book for your homework, they will usually consider these independently. So if they say tolerable deviation rate increases, they're saying tolerable deviation rate increases, but there's no change in expected population deviation rate. Because tolerable deviation rate by itself increasing doesn't have an effect. It's only relative to what the expected population deviation rate is. That's an important point to note. Now, interesting to note, you may remember this from statistics when you took this course, but unless the population is relatively small, which is fewer than 1,000 items, the population size is not highly correlated to sample size. If we get to 500,000 population items, and then we go to 500 million population items, there's actually not really a difference between the sample we have to select. I think you might get 1 or 2 more additional observations, but even then, that's a far call, and we'll see examples of that when we look forward. So population size generally not correlated with sample size, unless we're talking about really small populations. All right, let's go ahead and take a look. This is a question from the book, so I've got this in the slides right here, but I thought it'd be easier to kind of look at this conceptually through a table up here. So this is problems 827 and 28 in the book. Now, this is one we're going to do in class, but if you looked at the homework, this is actually something you'll do for homework as well. Not this problem, but a problem very similar to this one. So how do we consider this particular problem? And the answer is we need to look at the tables that I had you look at before. So there's 2 steps. The first step is pretty straightforward. We're going to establish sample size. Once we establish sample size, we'll go back and look at the other concepts in the slides here in just a second. So If I have a risk of incorrect acceptance of 5%, what does that mean for my confidence level, by the way? 95%, okay? So 95%, tolerable deviation rate of 6 and expected population deviation rate of 2. What is my sample size? Well, the answer is I'm going to go to my 95% confidence level table. I'm going to go to, what was I say? What did I say? It was 6 and 2%. So 6% for tolerable deviation rate, 2% for my expected population deviation rate. And the answer is 127. Okay, 127. Now, a couple of things to note here before we move on, and I'm just going to go ahead and plug in some numbers real quick so we have time to work through this. But a couple of things to note. You may be asking, what is that number in parentheses? The short answer is this is the number of deviations we can observe in our testing and still think the control is effective. If it's greater than 3, then we're basically going to conclude the control is not effective. We'll see how that applies here in just a second. Also, these stars over here, what do these mean? Well, these are basically saying that these are so large that effectively we have to test the entire population. So effectively, once we get such a small difference between our tolerable deviation rate and our expected population deviation rate, the table defaults to saying you have to test everything. So if I say I've got a tolerable deviation rate of 3, but I've got an expected population deviation rate of 1%, this is telling us, hey, that's such a small difference between tolerable deviation rate and expected population deviation rate that you basically have to test everything. So that's an area we don't want to be in, by the way. That's bad times right there. So yeah, 127 is going to be our sample size. Now, I could go through each of these, but let's see. Go ahead and plug those in. The process for this is pretty straightforward. There's 88 here, okay? Now, look, let's just take a quick look here and see what happened here. The risk of incorrect acceptance did not change, so our confidence level didn't change. And our expected population deviation rate did not change, but our tolerable deviation rate did. Our tolerance risk basically went up. This increased the distance between these two items, which means that we would expect our sample size to decrease. That, in fact, what happened? Yes, okay. Now we'll go ahead and take a look at this one. So we've got the risk of incorrect acceptance about 10%, and then tolerable deviation rate of 4%, and an expected population deviation rate of 1%. So let's go ahead and take a look at that. So now this is the second table, because if we're talking about a risk of incorrect acceptance of 10%, a confidence level has to be 90%. All right, so 4% and 1%, we have 96 with 1 in parentheses. All we care about here is the 96%, or 96 items, excuse me. Now we got a number 4. Number 4 is 76, which is actually a pretty substantial drop given that our tolerable deviation rate, the distance between tolerable deviation rate and population deviation rate effectively did not change. The numbers themselves did change, but the distance did not change. But the part of that is driving that is this expected population deviation rate of 0%. If we don't expect any deviations in the sample, that's going to make our the amount of items that we have to select in the sample go way down. So it's important to note. All right, so I'm going to go ahead and plug these in because we're going to be talking about this next part here in just a second. But let's go ahead and go back to the slides. That's enough for us to determine sample size, but we need a little bit more information to be able to determine whether the control is effective. Now, you may be saying, Dr. Barnes, I have all I need. I saw the number of parentheses. I'm ready to go. All right. If only it were that simple, right? If only it were that simple. You could be ready to go, but I might ask you a question. It's like, okay, how do we determine what the sample deviation rate is? And you're just going to be like, oh, okay. I probably should have listened a little bit longer in that lecture. By the way, there's a homework question about sample deviation rate. So it's entirely possible I could ask you a question like that on the exam. So the sample deviation rate is the actual deviation rate in the sample. Pretty straightforward. How do we calculate that? Number of deviations divided by sample size. So if I test my population, so say I test 100 items, I do a sample of 100 items, I send out 100 confirmations to customers, and I get 2 deviations back, two exceptions that I consider to be legitimate exceptions. My sample deviation rate is 2%, 2 divided by 100. That's all there is to it, all right? Where the fun part comes in this upper deviation rate. So if my sample deviation rate is 2%, what is my population deviation rate? And the answer is always what we answer in every accounting class when Dr. Barnes asks a question like this. It depends, all right? The answer is we honestly don't know. We can only extrapolate this information based on what we have observed in the sample. So I'm going to try to draw on here. Okay, so assuming that we've got a range of like 0 to 10%, all right? And you got to, I don't know if I can see that name. It's whoever, if anybody's watching this on video, I apologize. Imagine that I drew a bar with 0 to 10% on it. So we're at 2% right here in my crappy handwriting. Man, I gave my tax professor such a bad time about handwriting. My handwriting is terrible, okay? So where is the actual population, the deviation rate of the population? The answer is we don't know. It really depends on the characteristics of the population and how much the sample is representative of the population. But we assume it's somewhere around here, okay? Somewhere between, it's not going to be 0% because we already know that there's deviations in the sample, but it's going to be anywhere from right down here to somewhere up here above 2%. Now, if you're an auditor, logically speaking, are you more concerned about down here or are you more concerned about up here? The upper bound, okay? Which is why we consider the upper deviation rate. We want to calculate the greatest possible deviation we can see in the population. So it's somewhere in this range. We don't care about what the lower end is. We care about the upper end because that's the maximum amount we think that there could be in the deviation. How do we calculate that? The answer is we're going to take that 2% and we're going to add on something called the allowance for sampling risk. The allowance for sampling risk. Now, what is the allowance for sampling risk? There is a statistical method of calculating it. We're not going to worry too much about that because it's going to be given to us for the most part. Conceptually speaking, we need to understand the allowance for sampling risk, but we're not going to do too much in the way of calculations of that. Just think about it as some arbitrary amount, or not arbitrary, that implies that it's random, some amount that we add to the sampling risk to come up with an upper bound. So it's like somewhere between 0.5% and 3.5%. That's 1.5% upper sampling, allowance for sampling risk. That 3.5% is that upper boundary that we care about. Now, you will notice the last item here is really, really important. If the upper deviation rate is less than the tolerable deviation rate, so this 3.5% that I've said here is our upper deviation rate. If that's less than my tolerable deviation rate, I am fine. I have said that the greatest possibility of deviation in the population is less than what I can tolerate as an auditor. All right. We can conclude the control is operating effectively if that's the case. What about if that upper deviation rate, that 3.5%, is greater than my tolerable deviation rate? Then I basically said that there's a possibility that the population could actually have more deviations than what I can tolerate. Even the possibility of that is enough for me to say I don't believe the control is operating effectively. Does that mean the population is absolutely greater than my tolerable deviation rate? No, that does not mean an absolute certainty. It just means that I am not willing to take that level of risk on as an auditor because I think that there's a reasonable possibility that the population deviation rate could be greater than what I can tolerate. That is basically what we're trying to compute here. All right, let's go back to this example right here. So let's go ahead and plug in some numbers. So we've got right here four deviations in the population or sample size of 127, which gives us a sample deviation rate of 4 divided by 127, which should be 3.1%. Next, I need my computed upper deviation rate. Where does that come from? So the answer is, if we go to the second set of tables, and I go and say 4 deviations and a sample of 127, which I don't have that in the table. It's 125 is the closest I can get. I get 7.2. So I'm going to say computed upper deviation rate is 7.2%. So look back here up at tolerable deviation rate. This is the amount of deviation in the population I can tolerate. This is what I'm saying is a possibility, and it should have percentage there. For some reason, I never include the percentages. But 7.2% versus 6%. Is the control operating effectively? No, it's not. Okay, it is not effective. Basically, we're saying that there's a possibility that that we could have as many as 7.2% failures in the population. That is too great for my 6% tolerance. All right. Now, the sample deviation rate calculation is pretty straightforward. I don't expect anybody to have trouble with that. The computed upper deviation rate is basically the same as what we just did before. So I'm going to do another one. So I have 2 deviations in my sample, and my computed upper deviation rate in that case is going to be, what was the sample size? 96. So I'm going to go 2 to 96. I'm going to stay at 5.9. So I want to be more conservative. So if that's the case, 5.9 relative to 4%, that's not effective. Now, I focused on those 2. I do want to talk about these other 2 real quick because we're going to see them here in just a second. If you do these by the table, all of these come up as being not effective. okay? Simply based on the tabular analysis. Part of the reason for this is the tables are not precise, okay? The tables do not have the exact numbers. They're rounded to the nearest 10, or in some cases, the nearest 20 or 25, or the nearest 100, depending on how you get 200. So there's some problems with being specific as far as the tables go. What we're going to see when we get a chance to look at this in IDEA is that the IDEA tools are a lot more precise, which give us a little bit of happiness, because look at this right here. We had 0 deviations in our testing in our sample, and we still had to conclude the control was ineffective. Does that make any rational sense whatsoever? No. So this is why we don't necessarily want to rely on tables, because they don't have a level of precision that we need for this type of testing. But this is what we've got for our particular assignment. We're going to revisit this here in just a second. All right. So let's go ahead and talk about variable sampling very, very roughly. We're not going to talk too much about this. This is the only slide that I've got on variable sampling. But variable sampling, again, is extrapolating to think what we believe is the actual error in the, or the true error in the population based on what we observe in our sample. And we do need to refine our concepts a little bit more. Instead of tolerable deviation rate, we have something called tolerable misstatement, which should sound really familiar. Tolerable misstatement, remember that was the misstatement, the maximum misstatement we can accept at the account level. It's the same thing, exact same thing. The maximum amount of statement that we're willing to accept in a specific account or disclosure, it is inversely related to sample size. So basically, the larger our tolerable misstatement is, the smaller the sample that we need to test, because we can accept more error. We make tolerable misstatement too small, we have to make our samples really, really large, assuming we rely on sampling. And then we have something called projected misstatement. This is the estimated misstatement of the population of an account or disclosure. Now, how does this work? This is the really difficult part. Hopefully I'll have some time to go through this in IDEA. I may not get to it, but let's talk about it conceptually real quick. I test my accounts receivable, all right? My accounts receivable has a misstatement of $500 in the entire sample. As I said before, that doesn't mean that there's a $500 misstatement in the population. The misstatement of the population depends on how big relative the population is to the sample. So let's say that I tested 50 items out of a sample of 500. So if I have a $500 error, then I would expect my error in the population to be some magnitude of around 10 times greater. Now, is that precise? No, it's never going to be exactly 10 times greater. It would be wonderful if statistics work that way, isn't it? Let's get Dr. Alberts in here and just say, why can't you make things easy? No, but yeah, the idea being is that we want to have something on a magnitude of order, and that's how we establish that. So we can come up with good estimates based on statistical analysis, and usually those are going to lean towards a more conservative estimate rather than a liberal estimate. But ultimately, the concept is still the same. If I use these variable sampling techniques to determine what I believe the misstatement of the population is, I can compare that to my tolerable misstatement. So if I say that I believe it's misstated by $5,000 and my tolerable misstatement in the account is $10,000, I can conclude the count is fairly stated, because I can tolerate a misstatement of up to $10,000 and it still be okay. But what if my projected misstatement is greater than my tolerable misstatement? So I project that an account is misstated by $10,000. My tolerable misstatement is only $8,000. That is where we run into a problem. That is where I say, all right, I think the account is misstated. Does that mean that the account is actually misstated by $10,000? No, that is an estimate based on the items that we developed. Remember, we talked about misstatements back in chapter 4, and I told you that there were factual, judgmental, and projected misstatements. This is an example of a projected misstatement. We don't know what the actual misstatement in the account is because we can't test all 500,000 or all 5,000 customers. We just don't have that ability. We don't have the capability of testing all that. So if that's the case, we're going to rely on a projection for what we think the error is. That is where the projection from here comes from. All right. With that, we got done with the slides, but I do want to walk through some of the stuff that you're going to be experiencing in IDEA and kind of reinforce some of the things that we've already talked about. To do that, though, I'm going to need to log into IDEA, so give me just a second as I log in, because it's not native as computer. Talk amongst yourselves. What's your favorite sampling technique? I'm a monetary unit sampling person myself, Dr. Barnes. Good for you. I want to go tax track so I can avoid all the sampling stuff. I'm curious, do they do sampling in tax? They should. We should implement more sampling in everything, we'll do sampling here and there. So we don't have sampling in tax. We got makers. Modified accelerated cost recovery system. It's depreciation, folks. By the way, if you've been keeping up on the idea assignments, I think you probably noticed that they've become a lot more straightforward since the earlier ones, like the chapters 3, 4, and 5 stuff was pretty gruesome. And then now the other stuff is taking like 15, 30 minutes to complete. That's not necessarily true for this assignment, unfortunately, but I don't think it's difficult. It just requires a little bit more time. But this is where the payoff is for having done the idea assignments, is that the later ones are actually easy. So it's a pretty easy 5 points. Okay. So let's go ahead and talk about how we're going to provide, how we do some analysis here. So we're going to do some attribute sampling. Now, the good news for the attribute sampling setup is that you don't need to have a table open. I moved it over to this table right over here to the earthware clothiers testing, which we may look at here in just a second. But let's go ahead and see how we would perform the analysis. So I'm just going to do a pretty basic population size. I'm going to say a population size of 1,000. I'm going to do an expected deviation, sorry, tolerable deviation rate of 8%, and then expected deviation rate of 3%, and confidence level of 95. So these are all things that we put in numbers before. We could actually do the analysis before. And what is this going to tell us? This is the first one, is that our beta risk control is going to tell us what our sample size is. And based on these parameters, I have a sample size of 91. So in order to be 95% confident that our sample size is representative of the population, assuming that we can have a tolerable deviation rate of 8% and expected population deviation rate of 3%, we need to sample 91 items, at least 91 items. That's kind of what it's telling us right here. Now, that's all pretty well and good, and that's very, very simple and straightforward, pretty straightforward considering that we just did the same thing. We could actually come up with a much more precise number. And we're going to see how we can actually improve upon that here in just a second. But I do want to talk a little bit about some conceptual stuff before we move on. So remember, we talked about certain factors that did and did not affect our sample size. Let's go ahead and look at each of these independently. So I'm going to change confidence level to 90%. So if my confidence level goes down, what's going to happen to my sample size? I think it's going to go down. I need fewer items to be because I need to be less confident. So let's see what happens. Goes down to 63. So that was a pretty substantial change. Okay. All right. So let's change a couple other things. Population increased to 500,000. Is that going to change the sample? It'll change it some. Let's see, is that 500,000? That's 50,000. So 500,000. It'll change it some, but I don't think it'll be a substantial amount. 4 items. So we literally multiplied our population by 500 times, and it gave us 4 more items we had to test. So I guess, yeah, I guess that's a problem. What happens if we put 500 billion? Just out of curiosity. Did not change the sample size at all. So once we get to really large populations, then we don't have to worry about it. All right. So let's go ahead and change our expected deviation rate to 4%. Not 40, but 4%. Okay. What's going to happen to our sample size here? So remember I said this has to do with the distance between tolerable deviation rate and expected population deviation rate. As that distance becomes smaller, our sample size gets larger. So we're going to increase our sample size here. 123. Okay. Remember that's from 91, not 95, from 91. All right. What if I go back to 3, not 30, goodness gracious. When I go to 7 here, same type of effect. So we're making the distance smaller. So yeah, 122. Now that was again from 91 to 9. So let's just go ahead and make sure that we're clear on that. I should probably fix that. All right. So this was our original assumption for 91 sample size, 8 and 3. If I make tolerable deviation rate lower, I'm decreasing the distance between those two numbers, which makes my sample size smaller. All right. What if I make this 15%? What's going to happen to my sample size now? Make real small. Yeah, 30. Wow, that's the top sample I want. Less work for me. less work for me. All right, let's just have a little bit of chortling and guffawing. All right, let's see. 8%. What if I make this 7.99%? So there's a distance of 0.01% between my tolerable deviation rate and expected population deviation rate. Anybody want to guess what my population or my sample size is going to be? Going to be the population size. That's right. Compute 1,000. Yep. There's no distance virtually between those two numbers. So it's basically saying you got to test everything, man. It's like, that sucks. Be working a few extra hours this week. A few extra hours. All right, so that's kind of some examples of what we were talking about conceptually, but that's the sample size determination. What if we want to evaluate what happened in our sample? Let's move over here, all right? So one of your examples actually talks about what happens when you're testing 52 voucher packages and what happens when we test each of those. So I'm giving you a spoiler for your homework, which is not really a spoiler because you still have to do the work yourself, but at least you get to see what happens. Population size 1,000. Number of deviations sample, we're going to start with 2. That's going to change. Sample size of 52. Confidence level of 90. All right. So let's go ahead and compute. All right. So this is telling us that our sample deviation rate is 3.85%, which is basically 2 divided by 52. So that's our sample deviation rate. But because this is such a small sample, our upper error limit is 9.7%. So basically it's saying that this is like 3.85% where our actual number is, but this number could be as high as 9.7% because of our small sample size. So we have to use an upper deviation rate that's pretty large, pretty substantially large. And in this particular sample, I think our particular example that we're talking about says your tolerable deviation rate is tolerable deviation rate is 7.5%. Okay. So if tolerable deviation rate is 7.5%, what can we conclude about this control? Not working. It's not effective because our possible upper error limit, the highest possible error that we can expect in the population is greater than our tolerable deviation rate. All right. Different control, same sample size. We're going to do 1. Let's do the calculation. So I have 7.1%. So we've gone down in our upper error limit compared to 7.5%. How do we feel now? This control appears to be operating effectively. It is below that 7.5% threshold. Now, out of curiosity, what if I just have 0? So 0 deviations in the sample, that means the population deviation rate should be 0, right? Wouldn't it be nice if that was the case? Nope, that's not the case. Saying 4.2%. Now, does this make logical sense? If you pick a sample of 52 items, you test all of them, say there were no errors in this. Does that mean the population is completely free from errors? No, it's telling us, look, you got very lucky. Congratulations. And it's very unlikely that there's a deviation, but there are probably still a few deviations in the sample. Probably anywhere up to 4.2% of the sample could have errors in it. So that's what this is telling us. That's the maximum upper error limit for the population. And that's what gives us that information. The good news is if we were in that situation, we'd be pretty happy. Now, I do want to take a quick note on this one and take a quick crack at this. I don't want to go through everything so because we're running out of time. But remember back on, I'm not going to move off of the virtual desktop because I don't know what will happen if I do. But remember on the spreadsheet when I was looking and I was saying, on this one example, we had 0 deviations and we still had to reject the control. And I said that had to do with the tabular analysis and lack of precision. IDEA gives you a lot more precision in that regard. So let's go ahead and revisit that particular item. I'm going to say a population size of, I think I said 500,000 just to make sure I had a large enough population size. And what were the characteristics of that particular item? It said there were 0 deviations in the sample size of 76, and a desired confidence level of 90. And remember, our tolerable deviation rate was only 3%, which is not a lot of room, but we have 0 deviation rates, or 0 deviations a sample. So what happens in this situation? 2.98%. So if we observe 0 deviations, we should be able to conclude the control is operating effectively. That's intuitive. And this actually tells us that that's a more reasonable conclusion. And why is this different from the 3.3%? It's because when we were operating on a sample size of 76, we had to go with the most conservative estimate, which was a sample size of 70. And if you look in that table, it says 3.3%. When we're working with IDEA, it's going to give us exactly what that percentage would be for that number, which is 76. So in lieu of the opportunity to use a table, which only operates in increments of 10, or to use a statistical tool like IDEA, you would want to use a statistical analysis tool. Now, I'm not saying the IDEA is the only option. That's just the one we have available, but that gives us a lot more precision. All right. Last thing I want to do is I want to give you a little bit of insight of what happens when we do monetary analysis. So let's see. Let's move to the accounts receivable table. And I'm just going to start out plan. Now, the good news is what I'm going to be doing here. You don't need to worry too much about this because it does walk it out step by step. But what exactly is going on here? So I'm just going to give you a little bit of a taste on this. We're going to be doing testing at on the invoice total. And the numbers I'm going to give you are not the ones in the assignment because I'm operating with an old paradigm, an old document, and the new ones have changed a little bit, which is probably good because this one's ridiculous. So it says operating at a confidence level of 75%. Now, logically speaking, how many of you all would be happy if you were a client, if your auditor says I'm 75% confident? So you're saying, so basically a quarter of the time you're going to be wrong? It's like, okay, yeah, I'm not happy with that. 90% is a little bit low for my taste. That's not even all that high assurance. That's 1 out of 10 times. This is literally saying 1 out of 4 or 1 out of 4 times you're going to be wrong. All right, we'll say tolerable error is 900,000. Expected error is 1,000. Now, conceptually speaking, tolerable error and expected error seem to meet the same concepts as we talked about with tolerable deviation rate and expected population deviation rate. This is basically the tolerable error, what I can tolerate for the entire population. This is what I'd expect to see in the population based on historical precedent. There's a big difference here. Is that a good thing or a bad thing? That's a great thing. Same rule holds true. The bigger deviation, the bigger distance between those two numbers, the more certainty we have. Okay. Now, if I said the tolerable error was 900,000 and my expected error was 1 million, I'd be in for a world of hurt. That would be a problem because I'd say that I expect more error than I can tolerate, which again probably means that I'm testing the entire population again. All right, so let's go ahead and run that. Is there anything else I need to enter? So what is this going to say? We're going to estimate. So it says that my approximate sample size is 21 items, and my sampling interval would be $613,102 to $38. So real quick, I want to explain this. First of all, there's two things. Would you be happy as an auditor with a sample size of 21? I would be happy from the auditor perspective. I wouldn't have to do much work. Would your clients be happy with a sample size of 21? It's like you sampled 21 items out of this size population. That's ridiculous. You should have sampled far more. That has to go back to that 75% confidence level. That's why we have such a small population. If I increase the confidence level to at least a reasonable amount, let's say 90, then you'll notice that my sample size goes up pretty substantially. Still not that much, but let's go back to the original other piece of information. But I'm curious if you can understand or to know what we can say when we say sampling interval. What does that sampling interval tell us? That means the way we're going to assign items in our sample is that we're going to stack them up in a random order, okay? Basically, whenever they come up. And then we're going to count dollars. We're going to say $1, $2, $3 until we get to $102.38. Whatever transaction lies when that aggregate of transactions, we're going to take that transaction as our sample. Then we're going to start again, and we're going to count $1, $2, and $3, and going to keep stacking up our transactions. That is actually the random selection mechanism that IDEA uses. It selects every $613,102.38, which doesn't sound like random, but again, if your assignment is random, then that's a pretty good random distribution. So that's kind of what gives that note. Now, there's a lot more that we could delve into here. We could actually determine the approximation of this, but for the most part, you'll explore that as part of the IDEA assignment, and this is beyond the scope of what I'm going to test you on. So I think we're going to call it good here with 1 minute left, and we're going to come back for homework on Friday. I'll see you all then.